Good morning. And welcome to our Affluence webinar. Thanks for joining us on this lovely day. This morning we're going to go through, I'm going to talk a little bit first about what's in the world and how we're feeling about investment markets, and then we're going to talk about each of our two key funds, the fund and the Affluence LIC Fund. Just give you for what we currently like, what we're avoiding, and how we're positioning the portfolios in what is a tricky investment market. But of course, as a fund, say that, wouldn't I? So, quick disclaimer before we start. As I said, I'm going to talk about two of our funds, our retail funds. There's quite a bit of performance data and other bits and pieces in here around the portfolios, and then information's all current as at 30 June, unless stated otherwise. Just to recap what we do, we have three funds: the investment fund, the LIC fund, and the small company fund. And all three funds are based on the same premise, and that is that as an investor, you might be looking for better than average returns over 3 years or longer, regular income at a decent rate, which to us is 5% per annum, paid either quarterly or monthly, and to be able to avoid some of the bumps and hollows that come with investing in markets generally. So if we can give you a smoother ride than average, we'd be happy to do that. The other common features to the funds is that myself and Greg Lander, who are the key portfolio managers for all three funds, all co-invest in the funds along with our families. The first dollar in every fund was ours, and also we are paid solely on performance. So we take, as the fund manager, a percentage of positive returns for the fund, and if we have a negative return period, we have to make that up before we can charge a fee in the future. Snapshot of the first half of the year. So it's been a rough old ride generally. There's very few periods in history where both stocks and bonds have lost money, but that happened in spades in the last 6 months, or in the first 6 months of 2022. If you're running the standard 60-40 portfolio, for example, with US stocks and US bonds, you would have lost 16% per annum in the first half of this calendar year. Australia wasn't much better. Aussie bonds actually fell by 11.7% for the 6 months to June. So that's quite unusual. It was driven by interest rate expectations changing quite markedly. At the start of the year, the Aussie interest rates for a 10-year bond, government bond, was about 2%. By June, they'd gone to about 4%. And that meant if you were holding a 2% yielding bond at the start of the year, it looked pretty sick by June, when the standard was 4%. So hence the capital value of that bond appreciated, and that's basically how bonds lost money. You can see here returns for various indices for our three funds over different periods. So firstly, the first 6 months of the year, as I said, was rough. Bonds down, ASX down about 10%, and ASX Small Ords down 23%. For the full financial year to 30 June, all three of our funds lost a little bit, 2.8%, 3.8%. But as you can see, the other investment markets lost a heck of a lot more. And in fact, in July so far, all three of our funds have more than made up those losses for the last financial year. So look, no one likes not making money or even losing a little bit of money, but in this environment, we think that's a pretty good outcome. More importantly than that, if you look at the numbers over a 3-year period, which is what we focus on when we look at any investment and we look at our portfolios, and we ask you to measure us over at least a 3-year period, you can see the Affluence Investment Fund's done just over 7.5%, the LIC fund around 14%, and the small company fund around 14%. And all three of those have substantially outperformed the ASX and the small ords over that period. So again, that's a pretty decent outcome given the environment we've been in over the last 1 to 3 years. And looking forward, there's some reasons to be optimistic. While there's a lot of pessimism out there at the moment, there are some positive things happening, which I think will be good for investment returns going forward. Now, I'm not going to talk about our small company fund today because it's a wholesale investor-only fund. So if you are a wholesale investor, I would encourage you to go on their website, have a look at that fund. We're excited by the opportunity in small cap value stocks at the moment, and small cap value And if you are interested, let us know. Send us an email, give us a call. Very happy to talk through that in more detail if you are a wholesale investor. And if you're interested and you're not a wholesale investor, let us know as well, because we would like to open up that fund to all investors at some point, depending on the commitments we get for into the fund versus the cost of doing that. So store that one away for future reference. Now, some high-level things that matter. This is the most important one. These three guys are important to your investment returns, whether you know them or not. At the bottom right, we have Philip Lowe, who is the chair of the Reserve Bank of Australia. Most of you probably know him. They meet on the first Tuesday in every month and decide what our mortgage rates are going to be and our interest rates are going to be for the next month. The guy at the top here is Jerome Powell, and he is the US equivalent to that. He's probably the most powerful man in the world in terms of being able to impact financial markets. Both those guys have been blindsided by inflation in the last 12 or 18 months. Both groups thought that inflation was transitory and very much found themselves behind the curve. And they're now, in both cases, playing catch up, which, as you well know, has seen us have a succession of quite decent and quite regular interest rate increases. Interest rates massively in the late 70s, early 80s, which led to quite a large recession, but that was what was required at the time to bring inflation ultimately under control. And that's important because we may find ourselves in a similar situation where our reserve banks here in Australia and the Fed in the US, and indeed a lot of reserve banks around the world, have to choose between killing inflation or killing the economy. They've all said they will get inflation under control no matter what it takes. And the question really over the next 6 to 12 months is, in fact, whether they have to go further than they might think and whether they blink in doing that. Inflation is worryingly quite sticky and worryingly is still rising, or at least plateauing. It's not yet coming down. We think it will over time. But there's a bit of a lag to a lot of these inflation numbers, particularly around housing costs and rents. So it's not going to come down perhaps as quickly as people think. We're hoping that inflation comes down over the next 12 months or so, because that will allow the reserve banks to take the foot off the throttle on interest rates. But if not, as I said, they've got a very tough choice coming up. And part of the reason for the tough choice is because, you know, raising interest rates quickly is going to have a big impact, because there's so much debt out there, because interest rates have been so low for so long. A lot of people have really juiced up their borrowing. But the other thing, and most importantly, particularly here in Australia, is there's quite a big lag. So we've seen interest rate rises over the last few months, but a lot of people have fixed their mortgages in the last year or two. And so the impact for those people is not anything as yet. But over the course of the next 12, 18 months, you're going to see a large proportion of Australian borrowers come off fixed rates and onto variable rates. And at that point, their repayments could literally double, depending on when they come off and what rates they fixed at. So we're expecting at this stage that, you know, we're not seeing a lot of impact yet on the economy from these interest rate rises, but at some point next year, that impact is going to hit pretty hard, we suspect. You know, unfortunately, people won't stop spending until they're forced to. And at the moment, there's still quite a lot of savings out there, still quite a lot of people post-COVID found themselves in a pretty good position with money in the bank. And so they're continuing to draw down on those savings and to spend quite well, even though interest rates are going up. And we think that may lead us to a situation where over the next 5 to 10 years, we come into this cycle of raising interest rates to try and kill inflation, but not quite doing it, leading to a bit of a recession. Inflation falls back, interest rates come down, then inflation rolls back again, and we see that cycle continue. And that could be happening perhaps on a 2 to 3 year cycle for the next 5 or 7 or 10 years. And that's very much what happened in the 70s, where we saw 3 or 4 bouts of inflation 3 or 4 years apart until Paul Volcker finally took the knife to interest rates in the early 80s. That's an interesting investment environment to be in. It's very, very different to the environment we've been in. And we are positioned for an environment like this, where it pays to be flexible. And I'll talk about some of the things that might and might not work in that environment. But certainly what's worked, the high growth, no profit stock trade that's been paying dividends really since 2010 till about 2021 is probably over for now, well and truly. The good news is that if we are having a recession, there's probably never been a better starting point for Australia. You know, this is the job vacancies, for example. This data is a month or so old, but you can see clearly job vacancies are massive compared to what they have been in the past. And in fact, as at June, there was officially one job available for every unemployed person in Australia. And I don't think that has happened before. It certainly hasn't happened since 1980 when this data started. So we do find ourselves at a pretty good starting point, and that's good news for Australia. And I guess the US and a few other places are similar, where we are seeing everybody who, I won't say everyone who wants a job can get one, but certainly it's about as easy as it's ever going to be to get a job at the moment. Looking at markets generally, top down the ASX 200. So this is the ASX 200 index since about 2000. You can see it's sort of waved up and down. We saw the big increase in the late 2000s, the China-driven commodities boom, the GFC. We see the COVID crash here. And really, we think we're about fair value, maybe slightly above. I think we think fair value, Greg and I would debate it, probably somewhere between 6,600 and 7,000. So on average, it's fair value, but of course you don't have to be average. And a big part of what we do is look for things that are outside the norms, things that are cheaper than we think they should be. So you very much will not get a benchmark type return from us. We're going to have a lot of things in our portfolio that are not in the benchmark. So that's important. And I think, you know, a key thing I would say to any of you who look at various different funds and managers out there, you know, if you're paying a standard fee for a fund manager who basically tracks the index, you know, you're better off to either get a differentiated fund manager like us, or to just buy an ETF if you want the index returns, because that'll cost you a lot less money. And I think there's certainly a place for both. You know, we don't really enter into the active versus passive debate. We would say both have a place in your portfolio, but we very much are in the space where we want to be very active and very much adding value, particularly in environments where it's moving around a lot or when markets are falling. The US is a bit different. You know, there's three examples here of companies. You know, I would say 6 months ago we thought the US was pretty much nuts across the board, but it's a lot better priced now, given the S&P is down about 20% since the start of the year, and the NASDAQ was down about 30%. It's recovered a bit since. So here's three examples. You know, Facebook is now trading on earnings ratio of about 13 times. It's pretty reasonable. Of course, if there is a recession in the US, and a decent one, ad spending is going to suffer a lot. So that's an example of probably a company that's now reasonable value. Microsoft is an example of an expensive quality company. So probably trading on 25 to 27 times earnings, down from maybe 35 times at the start of the year. Great company, certainly not cheap. I would say it's still on the expensive side, even though it's got a good growth runway ahead of it. And finally, we've got an example of still reasonably crazy, which is this is a Ribbian Truck. For those of you who follow the world's newest automakers, Ribbian delivered about 4,000 new trucks last quarter. It's the first quarter of proper production they've had. They've still got a lot of teething issues to work their way through. Currently, Ribbian is down about 75 to 80% from its market highs of last year, but it's still worth $34 billion US, which to us seems a little bit crazy. Just to put that in context, that's about the same value as Woolworths or Telstra, or you could buy 5 Qantas for about $40 billion Australian and have roughly the same value. So we don't think it's a great buy at this point, and we're avoiding that sort of stuff. One area we are super excited about is resources, commodities. We have got a reasonable exposure, both directly and indirectly. So in our Affluence Investment Fund portfolio, there's probably somewhere between 7 and 10% commodities exposure if you look through into a lot of the managers we use. And here's a couple of examples why. Certainly if a recession's coming, we're going to see demand come off, but there's a longer term story here, and it's around climate change, electrification, and that general theme. And this is an example where you can look at nickel demand in 2021 versus the projected demand in 2030 just from Tesla. And again, you can look at lithium demand in 2021, about 500,000 metric tons versus the projected lithium demand just from Tesla in 2030 of about 4 times that. So certainly in battery minerals, in gold, we're interested. There's a big dislocation between the price of gold itself and the price of gold miners, that they're much cheaper than they should be. And then the other one that's quite interesting is oil, because getting us through this period of climate change is going to take longer than we think. And so we think oil is still going to be at elevated levels for some years while we work our way through this transition. And the flip side of that is that we also have a supply problem to go with our big demand. And the supply problem is simply that it takes such a long time these days to get a new mine into production. Depending on where you are, it can take between 7 and 15 years to go from finding the resource to putting a reasonable sized mine into production. And there's not a lot of new supply on the horizon. And so that means 2 things: that we are going to have a supply squeeze, and probably commodity prices are going to stay elevated and possibly even get higher over the next few years. And the second important thing is that if you're a gold miner in that kind of mid-cap space, where you've got an operating mine with a long mine life, you are going to be in demand. There's going to be a lot of takeover activity. I think we saw BHP having a crack at Oz Minerals this week. That's an example of where you're going to find the bigger miners and perhaps even sovereigns and companies like Tesla actively go out to buy miners and mines where they can get long-term supply under their belt. So for those reasons, we think resources are a pretty good bet at the moment, notwithstanding the fact that obviously if we have a recession, they're going to be volatile. So we do move our position size around a little bit, but if I look at that as a 3 to 5 year story, it's a pretty exciting one. Property's more of a conundrum, and the reason for that is normally in inflationary periods, property does well. But the problem this time around is that cap rates or yields had gotten so tight because of the low interest rate period that there's undoubtedly we're going to see damage on the yields. So we might see this situation where rents can still keep pace with inflation, but the yield someone is prepared to pay for a property is going to increase because interest rates are higher, and that's going to mean that the capital value of that property will fall. So there's this interplay. It's very much a property versus property situation of, will the growth in rents be able to outpace the damage from the cap rate expansion due to that increased interest rates? And look, the way we're playing property at the moment is we have about 8 or 9% of the Affluence Investment Fund in property, and it's predominantly in listed REITs that are trading at substantial discounts to their net asset value. So where we think the cap rate damage is already priced, if you like, we're sort of buying a REIT at tomorrow's prices, and then from there, if rents and yields improve, then we should get the upside from that. But we're certainly not overweight property at the moment. And we will see the same thing play out, we think, in residential, where rents are going up. There's a huge demand for residential property at the moment. But given where mortgage rates are going, there's no way property capital values can keep going up. So we certainly think residential is going to continue to come down over the next 12, 18 months for as long as mortgage rates are going up. There's a couple of things that do worry us on a medium to long-term basis. The first one is energy prices. And the main reason this is a problem, quite frankly, is because governments have mismanaged, mishandled the transition to cleaner, greener energy sources. They've rushed into it, they've put roadblocks in place, and they are forcing existing high polluters to shut down plants without replacing that baseload energy. And all that's the case in Australia here. It's certainly the case in the US. It's also the case in Europe, but as well as that, we've also got a continuing problem in Europe where we've got obviously the Russia-Ukraine situation playing havoc with their electricity and energy prices as well. So that's going to be an ongoing theme. It's going to probably continue to drive inflation a little bit higher off and on over the next few years. And the second issue which is emerging is food security. And again, Russia and Ukraine have a bit to do with that, but generally speaking, food is getting scarcer, food is getting more expensive. That's really not a problem for Australia other than the inflation impact, but it could turn into a humanitarian crisis in Africa and other places if we see genuine shortage of agricultural commodities over the next couple of years. And so that's something that could play havoc with emerging markets and could turn into a full-blown crisis in Africa. Finally, it's interesting and it's worth noting that there's a reason we diversify, and that is because markets can always surprise you. Markets do things differently to economies, and they don't necessarily react at the same time. As one example, this is a graph of the two best performing currencies so far this year, up till sometime in July. And you would expect when markets are tanking and things are going pear-shaped that the best performing currency would be perhaps the US dollar or the Swiss franc. In fact, the best performing currency has been the Russian ruble, closely followed by the Brazilian real. Now, pretty much no one would have predicted that in March, April this year, but that is in fact what's happened. So it's the reason why, even though we overweight things we think are cheap and that we should get the best medium to long-term returns from, don't forget that diversification is also one of the best things you can do to protect your portfolio from downside risk. Now, looking specifically at our Affluence LIC Fund, we'll deal with that first. This LIC Fund reopened to new investors in June this year after about a 12-month period where we closed it. And simply we closed it in June 2021 because we ran out of ideas. Following the correction up to June 22, we had plenty of ideas on the table, and so we've reopened that now. So you can either invest directly in our LIC fund, minimum $20,000, or if you invest in our Affluence Investment Fund, currently about 15% of the portfolio is invested in LIC. So you are getting some exposure to LICs through either of those funds. I'm not going to go through how LICs work and what they are. I'm assuming people who've listened to us before would know that. But essentially, we're investing in those 90 to 100 listed investment companies on ASX. They're essentially funds that trade up or down independently of the net asset value they have or the value of their investments. Currently, we've got around 30 of them in the portfolio. And when we put LICs in our portfolio, we're really looking for at least one of these three things. We're looking for top quality active managers that we think can outperform, and there are a lot of those in the LIC space, luckily. There's also quite a few dogs, but there's quite a few very, very good managers in that space. We want to buy them when they're cheaper than they should be, and that generally means that they're trading at a discount to the net asset value. How big a discount is very specific to the individual LIC, and Greg, who runs that portfolio day to day, tracks the current net asset value versus the trading price, and we see opportunities pop up there all the time. So we are quite nimble and we are quite active in this space. Certainly we've got some LICs we hold in the portfolio for 3 to 5 years. We've got others which will come in and out of the portfolio perhaps within weeks or months, depending on how that price moves and how the NTA moves. And the third opportunity is special situations and opportunistic trades. And that can happen, for example, at the moment where we feel like an LIC might delist, or where a transaction's afoot, be it an issue of capital or a change in structure that will lead to kind of a one-off gain from that NTA discount closing. And we've had a reasonable number of those over the last couple of years. What's been happening in the space is the underperformers are coming under pressure from their investors, shareholders, to deal with that discount and to make structural changes to fix it. So that's been a source of some upside for us, and we see that continuing probably for the next couple of years. In Taking a look at the discounts, this is a graph we talk about a lot. This is the average discount across our entire LIC portfolio. So for the first 3 years the fund existed, our LIC fund's been going since early 2016. For the first 3 years, it was sort of 6 to 8% discount on average, and it didn't change much. And then this is the COVID low. We had a succession of issues which caused those discounts to increase. But COVID was basically the zenith, and they got to around 25% temporarily in March 2020. And they were on a bit of a recovery story up until the start of 2022, where they've increased again. And the discount at the end of June was about 17 or so percent. Right now, it's about 15% on average. So that, to us, 15% is that area where we start to get excited about LICs particularly, and we tend to be overweight. So we're seeing a lot of opportunities at the moment. I wouldn't say they're massively cheap, but they're certainly cheaper than average. And within that portfolio, there's definitely some positions we are quite excited about. The portfolio is quite diverse, so you can see here there's Aussie global split, so a number of LICs, even though they're listed on the ASX, do invest globally. There's a range of different size LICs we currently hold, and a range of different discounts, but very, very little. We own one, I think, at a slight premium to NTA at the end of June, but generally speaking, the vast majority of the LICs we hold are somewhere between a 5% discount and 15 plus, which could be 20, 30, or even 40% discounts in some cases. We've also got a mix of strategies. The majority of the exposure in our LIC fund is ultimately to stock markets around the world. So you should think of this as an equity market product, and it has a similar kind of volatility profile and a similar, well, actually a better return profile than equities. We've done about 12 or 13% per annum in this fund so far. But certainly that's the sort of profile you should think of this as equity exposure, I think would be best. You can see here our top 10 at 30 June. Please don't rush out and buy these today, because some of these are currently holds in our portfolio. We're very, very active in the space. So, we could in fact be either buying, selling, or holding any of these right now. It does change quite quickly. But just talk you through some of the larger holdings. Thorney is run by Alex Waislitz, and it's a very much a value portfolio, trading at a 20+% discount. It's quite concentrated. We believe in that portfolio in the next couple of 3 years. We think it's got a lot of potential, even though in fact, up until early this year, it had been a serial underperformer. And that's a common theme amongst a lot of managers we use. We're quite happy to top up on a manager that has a very, very good long-term track record like Alex Waislitz, but has had a rough trot. Because generally those rough trots can be explained by the style they're using and the fact that it hasn't particularly suited that environment in that period. AEG is a market neutral LIC that's currently under takeover from WAM Leaders, and so we would expect over the next couple of months that fund will transition and we'll get some WAM Leaders stock in exchange for our AEG shares. So that's one of the catalysts for the special situations trades that we spoke about. VGI Partners, there's 2 LICs. That's a bit of a work in progress for us. We're working with them. We're talking to Regal, who recently merged with VGI. We're giving them a little bit of space to execute, but certainly it's been a serial underperformer for a couple of years, and we are expecting to see some improvement. Otherwise, we would expect that Regal will move to make some structural changes to these LICs. At the moment, we're picking them up between a 15 and 20% discount to net asset value. Alistair Aegis similarly have publicly said that if the discount doesn't improve, which it hasn't, they will take steps to fix it permanently. And so we're expecting that they will make an announcement on that in the next couple of months around taking some more action on the Asian Investments Fund. They've got form because they did about 18 months ago wind up their global LIC, and or not wind it up, they actually converted it effectively to an unlisted fund. Platinum, you'd all probably know, is a value manager who had a pretty rough trot when all the growth managers were going well. Platinum is slowly but surely coming back into fashion, and we're a big believer of their investment strategy and their potential over the next couple of years. Sandon Capital has been a long-term portfolio hold for us, and they are, I guess, an activist type of investor, very active in the mid to small cap stocks, and very much got some good returns going on. So certainly you're going to get a differentiated portfolio from Sandon. The discount swings around a little bit, so we do actively manage the position size there, but it is a stock that's generally been in our portfolio most of the time since we started the fund. Tribeca is a commodities play. Again, the position size changes quite a bit, as you'd expect with resources. But at the moment, it is obviously one of our larger holdings, and we were adding to that position in July. CD funds 1, 2, and 3 has been probably the best performing combination in the LIC fund. We're getting exposure there to a whole range of US private equity, unlisted investments, generally smallish to medium-sized companies run by a US private family office, the Cordish family, and they do an exceptional job of managing that portfolio. They co-invest alongside the CD1, 2, and 3 investors. The problem for CD1, 2, and 3 has been they've had a lot of shareholders selling due to factors that are unrelated to the investment performance. And that's a position that's been quite lucrative for us, where we've been able to buy fairly consistently. We probably bought, for 12 or 15 months from early 2020 through to maybe around early 2021 sometime. And we've been holding most of those since then. So while we're not currently buying, we're still quite excited about the potential in that portfolio, albeit a little bit wary about the US in general. NGE, a highly concentrated portfolio run by a couple of guys who are very astute. It does move around a fair bit. There's quite a lot of resources exposure there currently, but also quite a lot of cash, which helps to balance out the volatility in the resources. They've done a very good job over an extended period of time, but it's very liquid. So we have to be conscious of liquidity. So we can't have too big a position size in that one. WAM Strategic Value, many of you may know, which is Jeff Wilson's vehicle that he started last year. Essentially, he is doing a similar thing to what we're doing in the LIC fund, but through a listed vehicle. Because of the size of WAR, they don't have quite the investment universe that we do. We're able to be quite active in the mid to small LICs, whereas generally speaking, Jeff Wilson is more active in the larger LICs. And we think actually there's more opportunity in that mid to small space where we play. But certainly it's one where post-IPO, it's gone from a slight premium to a reasonable discount, and we've also seen the NTA fall as the LIC portfolio it owns has fallen. So while we didn't own it when it initially listed, we have been gradually buying that over the last few months off and on. And WAM Alternative Assets is actually the old Blue Sky fund, which Wilson Asset Management took over 18 months, 2 years ago, and have done quite a good job. That portfolio has stood up pretty well. And they've got a very specific mechanism around their management agreement to deal with the discount over time, which we think is quite good. And so, we think over time there'll be an opportunity for that to trade a lot closer to its net asset value than it is at the moment. So being both an alternatives portfolio and potentially seeing that discount close means it's quite an interesting addition to our portfolio. It works quite well with some of the pure equity investments. So that's a run through of the top 10. There's probably another, as I said, about 15 or so holdings in the portfolio at the moment. It does ebb and flow a little bit. Generally speaking, when markets are dislocated and things are happening, we might have 30 to 35 holdings. And when markets have moved up or they're less volatile, we might be down to 20 to 25. So you can get some sort of an idea perhaps about how excited we are by looking at the number of stocks in the portfolio and or looking at the average discount across that portfolio. Looking now at the Affluence Investment Fund, again, similar structure in terms of how we put the portfolio together, except that instead of investing in listed investment companies, we're investing mostly in unlisted funds here. And so essentially we're looking for two things. We're looking for talent and value. very, very diversified. Currently, there's over 30 managers in here. There's an allocation, as I mentioned earlier, to that LIC fund, which is currently is about 15%, and does vary between about 10 and 20 over time. And we also invest directly in a few other listed opportunities, which are principally related to listed REITs, maybe a direct listed investment company, and occasionally a direct listed fund managers. So we're very much sticking with our circle of competence in terms of any listed investments that we have in this portfolio. That's the current asset allocation. So couple of things to note: carrying about 10% cash at the moment. And the key changes to this portfolio over the last 6 months is that we have spent some of that cash as markets fell, but we've been quite cautious about that. The big change we made is that we reduced our hedges quite a lot. We were quite well hedged coming into 2022. And then as we came through till June, as markets fell, we tended to be exiting those hedges generally at a profit and taking the cash. And, we got to fair value comfortably, probably in late June, the ASX at around 6,500. So currently, the only hedging we have in this portfolio is a small amount to cover some of our US direct exposure. We don't currently have any hedging over the ASX, although if the markets keep recovering as they are, we will be at a point soon we'll be thinking about that again. Currently 15% of the LIC fund, and so you can look through that and see that consists of a mix of Australian, global, and some cash. Around a quarter in Australian equities, around 21-22% in global equities. I mentioned earlier about 8% in property, principally through listed REITs. About 3 or 4% directly in resources, and about another 4 or 5% indirectly through some of these global equity managers and LICs in the other part of the portfolio. Part of the thing that's held us back in terms of our returns, so I mentioned we've done about 7 or 8% returns over the last 3 years. Part of the frustration for that has been we've had generally between 25 and 40% of the portfolio in alternatives and cash over the last 3 years because of valuations, and that's delivered us very, very low returns. As we look forward, we're obviously now getting returns on our cash, which is good. We're up to probably 1.5 to 2% returns on our cash and rising. And we are, for the first time, starting to look seriously again at the fixed interest. So we're seeing some fairly very low risk stuff at 3 to 4%, maybe even a touch higher, and we're seeing some other quite interesting stuff at 8 to 10%. Being quite cautious in the space, but the good thing for our portfolio is that as interest rates do increase, that part of the portfolio does much, much better, and that helps the overall returns. As well as that, the other big trend we're seeing is we think there's going to be a big return to the value cyclicals being able to make very good money again. So we saw a bit of that in 2021. And we've seen off and on this year in 2022. We think as we look out 3 to 5 years, those value and cyclical stocks are going to be where the extra money is made, and we're backing a lot of good managers to do well in that environment. This is roughly our asset allocation. So we are overweight cash. The green bars are kind of our neutral positioning. If we felt everything in the world was fairly valued, that's roughly what our portfolio would look like. The grey bars are the range we allow ourselves to work within. So as cash, for example, the range is 5% to 20%. Our neutral setting would be 7.5%, and we're currently just above 10%. So we're overweight cash. If we see another correction, we'll be jumping back in. Slightly overweight resources, overweight global equities, and a tiny bit overweight LICs. We're underweight Aussie equities, but we've still got a very decent allocation there, underweight property and underweight debt and fixed interest. Within the equities buckets, as I mentioned earlier, we're very much underweight or no foreseeable weight to US stocks, and we are underweight, probably underweight Europe. We've got a little bit of Asian exposure and a little bit of emerging market exposure. These are the top 10 funds in Affluence LIC Fund portfolio at 30 June. The top 10 moves around a little bit, and the position sizes aren't nearly as large. So the first thing you'll notice is that the LIC fund was about 15%, but if you look through that, what you're really getting is about 25 to 30 LICs at sort of 0.5 to 0.6% average weight in the portfolio. So it's still very, very diversified, particularly when you consider every one of those LICs will then hold a portfolio of stocks. A large position for us at the moment is 3 to 4%. An average position is probably about 2%. We have, as I mentioned earlier, around 30 underlying funds in here. And the simple reason for that is that we can tell you with a high degree of confidence that we feel a manager is going to outperform over a full investment cycle. But it's very, very difficult to know exactly when that outperformance will come. And so every time we identify a manager we get excited about, who's doing something different that's maybe not reflected in the current portfolio, that's going to be adding something we don't already have, we've tended to add them to the portfolio. So that's why we've now got about 30 in there. Interesting enough, if you look at our top 10, I guess the main thing to take away from that is that they're all, certainly not a single one of them are a benchmark hugger. They're all doing something very, very different from an index. They all have a very, very good long-term track record. They've all outperformed the markets that they're investing in over the long term, and they all are differentiated from each other. So Bronte, for example, is long, short, long quality, short frauds and fraudsters and scams, and they have a very good system of doing that. Totus has tended to be long themes that they like and short stocks they don't like. Again, some of the rat bags and the scams perhaps more likely. Both Bronte and Totus have tended to go up when markets are falling. So they act as a very good shock absorber for our portfolio. And that's the reason there's some of the larger weights in it. Phoenix Opportunities Fund is an ASX microcap manager who's been closed for some number of years. So we can't add any more to that, but it's certainly been one of the best performing managers in our portfolio since inception, such that we've also worked with Phoenix. They've recently launched a global version of this strategy, and we've been one of the foundation investors in that as well. So it's currently about a 2% holding in our fund. Merricks has a fixed interest portfolio of predominantly different types of property and agricultural loans. They do an exceptional job. They're very good at risk management, and that's currently yielding about 7 to 8%. So the risk reward ratio is good there. It's been hard to find good risk reward and fixed interest, but that is changing, and Merricks is certainly high on our list in terms of the respect we have for the work they do in that space. Elliston, Packer, and CI Brunswick Fund are all quite a similar ilk in that they're all fairly unconstrained. They all can invest wherever they like, but predominantly tend to invest in equities, both Australian and global. And they're all run by founders who have a large slice of their own personal capital invested in the fund. So in the case of Elliston, it's Asher Jacob. In the case of Packer, it's Willie Packer. In the case of Brunswick, it's Peter Cooper. And that's important to us. You know, when we see a manager with a very good track record with about 6 or 7 different funds, the question we ask them is, well, where's your money invested? Where's the founder's money? And we follow the money in that case. All three very good performers, all three stalwarts in our portfolio. Arnott is a true hedge fund, long, short, in fact, probably market neutral a lot of the time. Exceptionally good long-term track record. Very, very different exposure. Currently has quite a bit of exposure to the resources market, but very little market beta, if you like, or direct market exposure. So that's been an exceptional performer for us over the last couple of years. We put it in the portfolio. And Terra's a firecracker investing in mid to small resources, but again, an exceptionally good long-term track record. Because of the volatility, it's rarely a bad fund. But we do tend to add to that, as we did recently. You might remember the commodities got absolutely smashed in June, and we added a little bit to our Terra portfolio after that because we felt like the value was exceptional. So that tends to be the way we play these longer term managers. Every time we see an opportunity where they screen very, very cheap, we'll add a little bit more to that existing investment. There's a wide range of investments in the portfolio, and I won't go through them all. You will get a replay of the webinar at some stage in the next couple of days. Plus, we'll send out a copy of the presentation, so you're more than welcome to swing your way through here and have a bit of a look and do a bit more homework yourself over time. But certainly there's a lot of names there. Every single one of these names has a stable investment team that's been doing what they're doing for a very long time. Every single one of them has outperformed the market they invested in over a very long. Most of them are in fairly eclectic markets. So, for example, in the emerging market space, we've paired a value investor with a growth investor. And then we don't have to think about too much which one will prevail in any given month. We just know that they're both going to do a very good job over the full cycle. In resources, we picked, in this case, 3 different managers doing 3 very different things. Terra, mid to small cap, Ausbil, long short, predominantly mid to large cap, Baker Steel, specifically a gold miner specialist. Given the current dislocation in the power market, we've had a ton of power in the portfolio now for 4 or 5 years, and they specialise in trading electricity derivatives. So they've been able to take advantage of a dislocated market to make very good money over the last couple of years for our investors. There's some of the listed REITs that we currently hold in the portfolio. They tend to be 1 to 2% holdings. I mentioned earlier City 1, 2 and 3, and we have about 1.5 to 2% invested in Kyland, which is a listed, well, it's currently a listed timber plantation, but it's undergoing a conversion to an agricultural property, and we've invested at a pretty reasonable discount to the likely end value of that. So as you'll see, some of these things are certainly not standard. That's what we like about the portfolio. We want to try and find things where we can put money to work for a minimum of 3 years with teams we trust to deliver us better than market returns. I guess the other important thing is distributions. In the case of the Affluence Investment Fund, we pay monthly. In the case of the other funds, we pay quarterly. For all 3 funds, we target 5% per annum. And for all 3 funds, we've exceeded that goal since inception. And the way that tends to work for us is that we will pay around 5% through the course of the year, monthly or quarterly, based on the unit price at the start of the year. And then at the end of the year, we'll look at the sort of year we had, the tax position, and if we've had a reasonable year, we'll tend to pay a special distribution. We also tend to pay a special distribution in years in which we've made reasonable capital gains. So that tends to mean that in the past, at least, most years we've managed to pay a special distribution in June for most funds. Obviously, I should say distributions are far from guaranteed. We tend to look at this over a 3-year period and say, look, as long as we can achieve 5% per annum over a 3-year period, we're happy to distribute at that level. The distribution numbers don't include franking credits, so also as a managed fund, any franking credits that the fund receives from listed investments or from unlisted fund investments, they all flow through and they turn up on your tax statement at the end of the year, which you can then include in your tax return. So depending on the fund, the Affluence Investment Fund, those franking credits have added 0.4 to 0.5% per annum, and the LIC fund actually a little bit more than that because the majority of the investments are listed LICs. So that's been a good addition as well. So that's probably the key points I wanted to make. So just to recap, inflation is back. We think it's here to stay off and on, and we think that we're going to see this swing between rates going up to kind of counteract inflation, leading to at least a mild recession, leading to falling interest rates, leading to inflation again as economies get stimulated. We don't think reserve banks are going to be able to solve this quickly. We think it might take 2 or 3 or 4 cycles of this to get us through it. We're not scared of that. We think that's actually a pretty good investment environment to be in, particularly for our style of investing, which is, we actually like volatility. We like when things move around a lot because that essentially creates more opportunities for value investors. We currently like resources, we like LICs, we like Aussie small caps, and we like value managers. They are predominantly the overweights in our portfolio. We're being much more selective about property through REITs. We're being much more selective about global equities, and we're starting to get interested again in the fixed interest and debt space. We are avoiding or have very low exposure to US equities. We have very low exposure to quality large caps, predominantly because we still think they're expensive, using the Microsoft example from earlier, and we're avoiding the loss-making high growth companies because the world has changed and they still haven't faced reality in terms of their share prices. And then finally, we are seeing returns improving in some areas, particularly obviously cash, the fixed interest debt complex, and cyclicals and value stocks. Whilst they're going to be volatile, we are going to see some opportunities to make some very, very good money, we think, over the next few years in that space. And finally, just to end on a positive note before I ask for any questions, obviously everything has changed. We think the environment that prevailed from, say, 2010 to 2021 is no longer. High growth is not making a short-term comeback. And that doesn't mean growth companies can't be good investments, but the easy ride you had investing in growth companies over that period is definitely over in our view. It's much more going to be a stock pickers, an active investors market, and a value investors market for the next few years. The good news is Australia is probably the best place in the world to live, and certainly in our view, one of the best places in the world to invest from in the next few years, because there's a lot of opportunities, not only in our home market, but also it's easy to invest globally now as well. So we're quite positive on the Australian economy, and we're quite positive on the Australian markets for the next few years. With that, I will leave the main presentation, and I'll perhaps give you an opportunity to ask questions. If you'd like, you're welcome to just find your way to the Q&A panel on your webinar and to type in any questions you've got, and we'll do our best to answer them as we go through if we have any. Okay, so we do have a question coming through. Thanks, TG. The question is, what risk do you anticipate for the current China geopolitical situation? How are you managing the risk? Good question. It's tricky. I think everyone looks at the Russia situation and says, well, that could happen with China as well, and that it escalates, very quickly into a global war, and, Chinese stocks become a real problem. Certainly that is a risk. Couple of things. We don't have a lot of direct exposure to, in fact, very little direct exposure to China. The majority of our emerging market exposure is through other Asian countries and through other emerging markets generally. So we have very little exposure. Where we do have exposure, it tends to be where we're seeing extreme value. So the Hong Kong market in general at the moment is incredibly cheap on a historical basis because a lot of geopolitical uncertainty is priced in. So there is a price at which we will take on some of that risk, and we're very happy we're getting paid to do it. I think if we added up our current China exposure in our portfolios, it would be very low single digits in the investment fund, maybe 2 or 3%, and probably similar in the LIC fund. And in particular, a lot of that is through the Elliston investment in the LIC fund, which we would expect we might exit in the next few months as well. So that's an example of China. I mean, the reality is for us, any investing we do offshore, we would only do it where we feel we're getting a premium return over and above what we can get in Australia. So to make any investment in a global fund or a global stock, we've got to be saying, well, look, if we think we're going to get 8 to 10% out of Australia, we want to be getting at least double digits to take any more risk, because any investing you do offshore is going to come with additional risk. You've got currency risk, you've got sovereign risk, you've got tax risk and tax leakage and a few other things. You've got a lack of franking credits. So you've got to factor that in now before you invest offshore. A question around put options. So can we explain them? When do we use them and how much have they added to returns? Again, it is a question we get a fair bit. So what we tend to do, we use two different types of hedges in the portfolio. We use index put options predominantly to protect against falls in the ASX. And the way they work is effectively if the market's trading at 7,000 points now, we might enter some put options that protect the portfolio to a degree. If markets fell to say somewhere between 6,800 and 6,700, they tend to be 1 to 2 months out. So what happens then is if the market falls quite quickly, we make money out of those put options. Then that offsets some of the losses we might incur from the investments we have that are exposed to the ASX. So it is, it's not something we use all the time. In simple terms, we would need to feel like markets were 5 to 10% overvalued before we would usually think about holding put options. So we're just getting interested in the ASX again now at above 7,000. We might look to redeploy. And the level at which we hedge will depend on how far overvalued we feel like the market is, what else we've got in our portfolio, and how much risk we actually want to manage. So at the start of this calendar year, where we felt like markets were quite well overvalued, the ASX was 75, 76, even 7,700 for a while. So 8 or 10% above where it is now, we had more of the portfolio hedged. In the US, we tend to use just a more standard futures type hedge. So what that means is we pick a point, and to the extent markets go up or down from that point, we will make or lose money on the hedge. So the good thing about put options for the ASX is that if markets go up, we don't really lose much. We lose a tiny bit of premium. In the case of the US hedges, we will only hedge the US market to cover our direct exposures, and then only a portion of our direct exposures. So, for example, now we have a little bit of hedging over the US market, and that's because we hold one of the Magellan LICs in our portfolio, to use one example of the US exposure we've got. It's currently trading at 15 to 20% discount to its net asset value. We think in about the next 18 months to 2 years, Magellan's going to take that headache away, and it'll probably end up giving us a solution at much closer to NTA, and we'll be able to take advantage of closing that gap. That'll be extra return we can generate, but we're not prepared to necessarily take all of the risk on the US market over that period. So we partly hedge some of that US market exposure. And so what that means is the combined returns will be mostly a function of whether Magellan actually does take action to close that gap, and we'll only have a small amount of market risk up or down against that holding. Over time, index options, look, I think we've over the years gone between making a little bit of money on them and losing a little bit of money on them. The reality is, if you have hedges all the time, it's going to cost you between 4 and 10% per annum to fully hedge your portfolio. So you can never use them all the time. It's partial insurance, and it's really only used where we feel the risk reward is worth it. So I would never want to give anyone the view, for example, that we're ever fully hedged. That's not going to be the case. What we're really aiming for with all of our portfolios is perhaps to take half or a bit less than half of the damage where markets correct. And that puts us in a position to stem the cash and take some action to take advantage of the cheap stocks. We've got a question on private equity. How do we think private equity opportunities look for the next few years? I think private equity for us and private infrastructure and direct property, all those kind of unlisted style, illiquid style of investments have a similar feature to us. Now, certainly private equity has been exceptionally profitable over the last 10 or 15 years, but I think it's going to get more tricky from here, so we're a little bit cautious. And I guess the important thing in private equity is you've got to be very careful what you're buying. So if you are buying a brand new private equity fund today, it's likely to be 2, 3, or 4 years before you're going to get any reasonable payback on that, because there's generally a decent lag between when the investment happens and when you actually see the upside from that. So from that point of view, we're certainly not investing in any new private equity funds. We have got one in the portfolio directly, which has been going for 18 months or so, and we've got obviously our CD1, 2, and 3 exposures, which give us access to a lot of live private equity deals at a pretty decent discount. So for us, generally speaking, we're not buying the unlisted stuff, we're not buying the new stuff, we're buying the seasoned things where we can buy them perhaps in a listed environment at a discount to the most recent valuations. A general view on alternative assets versus equities, that's another very, very good question. I think, let's see, I think it's a very broad church, alternative assets, I guess. The first thing I'd say is equities are now better value. So going forward, it's likely that we will have less alternative assets in our portfolio and more equities in our portfolio than we might have had on average over the last 5 years or so. As to what alternatives we would look at, look, I think it's been a very difficult market to invest in for the last few years. There's been not a lot of things, outside of the hard assets, outside of private equity and hard assets, so infrastructure and property. Generally, hedge funds, macro funds, market neutral funds, even a lot of long short funds have just been different ways to lose money or to make not much money for the last 5 years or so. So a lot of hedge funds we just ignore immediately because they're just too volatile. Where we do get interested is true alternatives assets. So we are looking at the moment, I mentioned the Atunga Power Fund, for example, which is investing in energy derivatives, very much uncorrelated to anything else that's going on out there. So that's been a constant position for us for a few years. We are looking at a product at the moment which invests in US gas wells under land. I don't know if it's going to get past muster. It's a complicated space, and we've got to get through the kind of climate change questionnaires on it, so I'm not sure if it'll make the final list. But there are things we will look at if they're genuinely differentiated. But as a rule, if I've got a choice between something that's simple and complex, and they're both the same relative value, I'm very much more happier, and Greg's very much more happier to take the simple answer. So we would very rarely invest in anything where we don't feel like we can understand very deeply what the manager's doing, how they're making their money, and what's driving the returns in that particular strategy or asset class. I think that's it for questions now, but if anyone would like to ask a final question, I'll just stay on the line for another 30 seconds or so. Otherwise, I think it's fair to say that we're actually quite excited about the market we see ahead of us for now. I think we're seeing lots of things that are coming onto the radar that haven't been on our radar for years. Fixed interest being the main example. And every time we see a market correction, even if it's a 5 or 10% correction, that throws up a new batch of interesting things we can look at. So I think for us, for all 3 funds, we're pretty comfortable with the portfolios we've got right now, that they can deliver pretty decent returns over the next 3 to 5 years. And we're also pretty comfortable that we're going to have a constant flow, given the environment we think is going to be out there, a constant flow of opportunities over the next few years as well. So that bodes quite well to us. I think that's it. We've got no more questions. So I appreciate you all attending. Thank you very much for your time. As I said, we will send out a recording of the webinar in the next day or two, along with a copy of the presentation. As always, you're more than welcome to give us a call at any stage to have a chat and ask any more questions you've got. or to send us an email when it's easiest for you. So thank you for attending, and thanks for your time.